Welcome to the Explainer. Today, we're diving into a really critical question for the Eurozone. What happens when its supposedly single, unified financial market starts to act, well, not so unified? A fascinating piece of research doesn't just guess, it actually measures this fragmentation and uncovers a hidden risk amplifier that affects the entire system.
So the paper we're digging into is an IMF working paper from Benjamin Mosk and Nander Vette, and it's called Euro Area Financial Fragmentation and Bond Market Stability. Their whole goal here was to get past just talking about this issue and actually build a solid, rigorous way to understand the threat.
And right there in the abstract, they drop the bombshell. In what they call a higher fragmentation regime, bond markets are more vulnerable. And they're not just talking about one or two countries, they're saying this is a systemic weakness for everyone. So the big question is, how do they prove it? That's what we're here to unpack.
All right, so here's our game plan. We're going to follow the author's logic step by step. First, we'll pin down the central question they're trying to answer. Then we'll deconstruct the really clever three-step methodology they built. After that, we'll look at the verdict, the actual results, and finally, we'll wrap up with the big takeaway.
Okay, first up, the central question. So what exactly is this invisible threat of fragmentation that the researchers are trying to get their hands on?
So, at its core, financial fragmentation is what happens when one big market stops acting like one. Think of it like this. Instead of a superhighway where money flows freely, you suddenly get a bunch of local roads with roadblocks. And in the Eurozone, you can almost always see this as a split between the core economies, like Germany, and the periphery economies like Italy and Spain.
And this, right here, is the million-dollar question. You know, it's one thing to have a hunch that fragmentation is bad. It's another thing entirely to put a number on it, to actually measure it, and then run an experiment to prove, with real statistical evidence, that it makes markets more fragile.
Okay, so how did they pull this off? Well, they came up with this really brilliant three-step methodology. This is basically the engine room of their whole study. Let's break it down.
It's a simple, really elegant process. First, you've got to measure the thing you're interested in. So step one is to measure fragmentation. Then you need to isolate the external force you want to test. So step two is to identify pure global risk shocks. And finally, you smash them together and see what happens. Step three is to test the impact.
So, for step one, how do you measure something as slippery as fragmentation? The authors grabbed a super powerful statistical tool called Principal Component Analysis, or PCA for short. Its job is to find the main underlying patterns in a really messy data set. And in this case, that data set was the weekly change in government bond yields for the 5 biggest economies in the Eurozone.
And the PCA, man, it delivered something really cool. It pulled out two main patterns. The first one, PC1, was just a common factor. You know, a rising tide that lifts all boats, where all the country yields basically move together. But then there was PC2, the second pattern, and this is where it gets interesting. This one was all about divergence. It perfectly, and I mean perfectly, captured that split between the core and the periphery, where German, French, and Dutch yields were moving in the opposite direction from Italy's and Spain's.
And this chart right here, this is the aha moment that gives them their custom-built indicator. That second component, the one that captures all the divergence, explained about 20% of all the movements in the market. So the authors basically said, okay, our fragmentation index is simply the rolling 12-month share of all market moves that are explained by this divergence factor. When that share goes up, the market is fragmenting. Simple as that.
All right, on to step two. They've measured fragmentation, now they need to isolate a pure global risk shock. For this, they used a seriously sophisticated model called a BVAR. You can think of it like a really smart filter that sifts through all the daily market noise, like central bank announcements or random economic data, to isolate just one clear signal, a true shift in global risk appetite.
Now this table, this is how they tuned that filter. They laid down some ground rules, what they call sign restrictions. They basically told the model, look, a real risk-on shock should make stocks go up in both Europe and the US. It should push up long-term yields, and it should make the euro stronger. By setting these rules, they could be confident they were isolating pure shifts in global risk sentiment, not something else.
And that brings us to the final step, step 3, where they put it all together. Using a method called a local projections model, they essentially run a controlled stress test on the market. They take the risk shocks they just identified and they hit the market with them, carefully measuring the reaction. But, crucially, they compare the reaction in high fragmentation times to low fragmentation times.
So the whole setup boils down to this one really specific question.
If we hit the market with one of our pure, one standard deviation global risk shocks, how big is the jump in credit risk? And, this is the key part, does that jump get bigger or smaller depending on the level of fragmentation we measured back in step 1?
All right, they've built this incredible toolkit, they've run the experiment. So, what did they find? What's the verdict?
And the results are, well, they're pretty jaw-dropping. Just look at the immediate impact on sovereign CDS premiums. That's basically the market's insurance premium against a country defaulting. The difference is like night and day. In a high fragmentation world, bam, a huge, statistically significant spike in risk. But when fragmentation is low, that same shock does basically nothing. It's statistically invisible.
Let's just put a number on that to let it sink in. We're talking about a 1.4% jump in sovereign risk premiums from a pretty standard global shock, but only when the market is already fragmented. That's not a small effect. That is a massive amplifier.
And here's something that's absolutely crucial to understand. This isn't just a periphery problem, not by a long shot. Sure, the effect was a bit bigger in the periphery, but look at the core countries. Their bond markets also became way more fragile, seeing over a 1% jump. Fragmentation drags everyone down.
And the pain doesn't stop with governments. The contagion bleeds right into the private sector. The analysis found the exact same pattern in corporate bonds. This means fragmentation makes it more expensive and more risky for actual businesses across the entire euro area to operate and invest.
Okay, so after all that analysis, all that data, what's the big takeaway here? What should we walk away with?
Well, the message from this research really couldn't be clearer. First, fragmentation isn't just some fuzzy idea. You can actually measure it. Second, when it's high, it acts like a giant megaphone for global risk. Third, and this is so important, this vulnerability hits everyone: core, periphery, governments, and corporations. And that leads to a really powerful conclusion. Policies that make the financial system more integrated aren't just about politics. They are a direct, practical way to build a more resilient and stable market.
And that leaves us with a critical, forward-looking question, doesn't it? This paper gives us the blueprint. It proves that a fragmented market is a fragile market. So the real question is, when the next big global crisis inevitably comes knocking, just how well will the Eurozone's financial system actually weather the storm?